Good afternoon or good night, depending where you are connected. And thank you for joining us at the 8th edition of the Global Pensions Program. It is a pleasure having you with us today. Buenos días o buenas tardes y muchas gracias por sumarse a esta sesión de la octava edición del Global Pensions Program. Es un placer tenerles con nosotros. Before we start, I would like to go through the usual housewarming messages that probably by now you already know very well, but just in case some of you just connected. First, this session will be conducted in the English language, but we offer translation services. If you want to access those services, please locate the interpretation icon at the bottom of your screen. If you click there, you will be able to choose the language. Esta sesión será llevada a cabo en inglés. Así que si ustedes desean acceder a la traducción simultánea, por favor localicen el icono de interpretación abajo en su pantalla. Si le dan clic ahí, podrán acceder al servicio de traducción. Dejaré unos segundos para quienes deseen hacer eso, lo pueden hacer ahora mismo. Okay, I remind you that during the presentation, your cameras and microphones will be off. Please submit your questions using the Q&A box that is also at the bottom of your screen. I will be collecting those questions and speaking them out loud for the Q&A session at the end of the presentation. My name is Manuel Garcia Huitron. I am with the pensions team at the Inter-American Development Bank, and I will be taking you through the next 45 or 50 minutes. Before we move forward, we would like to know who is in the audience with us. A question will pop up on your screen right now. Please take some seconds to answer it. We look forward to your answers. Answers should be coming in a few seconds. There we go. So most of you work for the public sector. So that we had some good share as well from the private sector, academia, and some students as well. Thank you very much for your answers. Now I'm thrilled, really thrilled to introduce one of the most innovative minds I've ever met. Arun Muralidhar is the founder of M-Cube Investment Technologies and founder and client CIO of Alpha Engine Global Investment Solutions. He is an expert advisor to the World Economic Forum's Retirement Investment System Improvement Project and the Strategic Retirement Advisory Council for the Investments and Wealth Institute for their Retirement Management Advisory designation. I know Arun both on a professional and a personal level, and I can tell you Arun is also, besides everything I just mentioned, also a very generous person. This shows up in his relentless efforts to devise solutions to the retirement challenges around the world. Ladies and gentlemen, I'll leave you with Arun Muralidhar to speak about one of these innovative ideas. Thank you, Arun, for being with us. The floor is yours.
Thank you, Manuel. I really appreciate that. That's very kind of you. And thank you to all of you who've joined this presentation. And I wish you a good afternoon or a good evening, depending on where you are. Yesterday, you had the benefit of listening to Professor Bob Merton talk about the six-pillar approach that we have suggested for retirement security globally. And I just want to make sure, Manuel, that you can see my screen. I'm just trying to start the slideshow.
Yes, probably you can, yeah, indeed, do slideshow.
For some reason, it's not starting now. Sorry about that technical. Okay, sorry for that slight technical challenge. I take it you're able to see the slides right now.
Yes.
Okay, so yesterday you had the benefit of listening to Professor Merton. And in Professor Merton's presentation about the recent paper that we've written, talking about the 6-component approach to funding retirement, he mentioned that one of the ideas was the notion of a selfies bond. And so today what I'm going to do is take you through the details of this selfies idea. And basically what we've done is come up with a simple innovation that is going to show you how it addresses the global pension challenge that's faced. And the 5 key points I want to make right now in the beginning, and I'll come back and repeat it at the end, is that what we tried to do with the Selfies innovation, which is a pension bond, was create a bond that would have the cash flows that most people expect from a pension plan. The second key point was that we wanted to make sure that it would work in all countries that have a bond market. So the same simple design could be used by any country that wants to make this innovation. That it would provide the protection against some of the key risks that people have in retirement, especially standard of living risk, which I think Professor Merton talked about a little bit as well. And most importantly, that it wouldn't require a lot of additional training, and it could be used by people based on what they already know. And finally, that it would involve relatively few transactions so that we could keep the cost down, but at the same time, try to give people the same feeling that they got out of a defined benefit pension structure as well. The next slide in my deck essentially has my biography, which I'll skip, but very quickly, I used to help manage the World Bank's pension plan before I started to work for JP Morgan and I started my own companies. And along the way, I've written 2 books on pensions, pension reform specifically. I've written 4 books on pensions. The first was a book with Professor Modigliani on how to reform social security systems. And my most recent book is about how to improve the performance of defined contribution pension plans. So with that as background, let's take a look at what is the big macro challenge that countries are facing globally, and especially this is the case in Latin America. And as Professor Merton may have mentioned, social security systems and typically defined benefit systems have been under pressure globally. And as a result, what we find today is that DB plans are either closed or they're not offered to individuals anymore. And the trend has been to pass the responsibility to individuals into DC plans. So on a macro basis, whether you're in the developing countries or in the developed countries, we've seen this trend towards closing of DB plans, non-offering of DB pensions, and more people having to depend on their defined contribution pension plans for their retirement security. Now, I think underlying this bigger trend is a very important trend that you find not only in Latin America and countries in Asia, but also in countries like India, namely what we call the uncovered person problem. Many individuals are not covered by any plan, either because they work in the informal sector, or alternatively, it could be the case that even though their company offers them the pension plan, they don't participate. And this is a real challenge because if people don't start to save for retirement early in their life cycle, then when they get to retirement, they're not going to have enough resources to survive. And then the government is going to have to bail them out. The third major trend is that what we find globally is that longevity seems to be increasing, though COVID has created a little bit of a distortion in the middle. And people have moved away from the nuclear family so that now each one tends to be more dependent on themselves for planning for their retirement. And then finally, which is a challenge in most of the developing world, but even in a country like the United States, where I'm based, is that we have low levels of financial literacy. And I'll talk about this a little bit more in a few minutes. So when we think about all these global challenges at a macro level, we realize that there is a potential pension crisis unless we do something about it. And as Professor Merton mentioned yesterday, the goal is still unchanged, which is people want to be able to maintain their pre-retirement lifestyle until death. So when we started to address this problem about 5 years ago, the thinking that we had was in designing some kind of a solution, we need to think about what are the solutions in other industries that make it very easy for them to be adopted. So for example, when you go to rent a car or you go to buy a cell phone, you're pretty much able to open the cell phone box, take it out, and within a few minutes, you're able to use it. In designing a solution for the pension problem, we wanted to use that same concept, which is that we should have people be able to use this innovation without additional training. So that was one of the high level goals that we imposed on what we were trying to do. Now, when you think about the micro level challenges, there's a slight mismatch between what individuals want and how the industry has responded. And again, yesterday, Professor Merton had talked about the difference between people expressing their retirement as an income goal versus what happens when you express it as a wealth goal. If you ask an average individual what their goal might be in retirement, they'll probably tell you that they want to maintain their standard of living with some degree of certainty. That's probably expressed better in terms of retirement income units. They can tell you, I could use 50,000 pesos a year in addition to everything that I get to be able to survive with my current lifestyle. And the second important thing is they want to have access to products that they understand so that they don't feel like they're buying something that's beyond their capability. The challenge has been that the response from the industry is to give them products that are entirely focused on telling them how much wealth they've accumulated, which doesn't relate to how much income that's going to be able to generate. So if you look at typically your pension statement, it tells you how much wealth has been accumulated. It doesn't tell you very much about your standard of living. And then I think yesterday, as Professor Danielle Mantilla had mentioned, there haven't been a lot of products which guarantee you what we call a safety first approach to allow you to get to retirement and have a comfortable standard of living that you can be guaranteed. That's typically more in the defined benefit world, not so much in the defined contribution world. And more often than not, the solutions that are out there require some amount of financial literacy. Now, why do we know that this mismatch is a challenge? Because when we look at global surveys about the share of current retirees who say they do not enjoy the same standard of living they had when they were working, which is the chart on the right-hand side, what you find is that the percentage of people who feel that they didn't have the same standard of living when they're working is relatively low, which means people have taken a haircut in their standard of living once they stopped working. So again, we wanted to make sure that we could address this challenge without requiring people to be more sophisticated. Now, a related micro challenge is that when you look at a defined contribution pension plan, there are many, many challenges that are faced by the average individual because first and foremost, unlike a defined benefit pension plan, which involves multi-generational and multi-cohort risk sharing, in a DC plan, all the risk is transferred to the individual and they have only one lifetime in which to get all these decisions correct. And the decisions typically are how much to save, how should I invest that money, and then how much should I decumulate and at how fast a rate so that I don't deplete all my resources before I die. Now, normally these questions are complicated even for professionals like me. But if you layer onto it the fact that people tend to be financially unsophisticated, then it makes it even harder. So there have been a number of global case studies that have been done where they've asked people simple questions about compounding interest or the impact of inflation. And maybe 50% of the population typically isn't able to answer 3 out of 4 of these questions. So if they're not able to do the basic math behind inflation or compounding, and then we're asking them to make these complicated decisions on how much to save and how to invest, we're looking at potentially problematic outcomes. So finally, when we think about how most defined contribution systems are set up, and this is true even in Latin America, You accumulate all your assets with one party, and then you're expected to go to another company and then go and acquire an annuity from them. More parties involved, more costs. That means you get a lower pension. So one of the things that we noticed was that not only do people have the wrong goal, which is they've been focusing on a wealth number rather than a retirement income number, but also that the instruments that are available to them in achieving their goals are not appropriate. And I'm going to expand on this a little bit more in the next few minutes. What's most interesting is just because somebody has gone from a defined benefit to a defined contribution pension plan, it doesn't change the fact that their goal is unchanged. And what is their goal? Their goal is to make sure that they get a steady cash flow till they die, right? And if it's guaranteed and it's protected in real terms, then there's a good chance that they can preserve their pre-retirement lifestyle. So rather than putting it into words, what we thought we would do is put a chart together that shows what are the desired cash flows that people want in a retirement pension plan. And so here we've modeled a 25-year-old person, and I've put down $50,000, but this could be 50,000 pesos, it could be 50,000 reais, depending on the country. That number could change, but it doesn't change the basic structure of this chart. And essentially, while they're working from age 25 till the letter R, which is age 65, they have no need for cash flows because they're working. They've got income that's coming from their job. But when they get to retirement, what they want is a steady stream of cash flows from the date of retirement till they die. Now, for simplicity, I'm going to assume that they live for 20 years after retirement, and we can talk about longevity as well later on in the presentation. But in this simple example, the cash flows would be zero cash flows from 25 to 65 years of age. And then once you hit retirement, then you have cash flows that are fixed at, let's say, a level of 50,000. The problem, as I said, is that no asset today has this kind of cash flow profile or bridges this massive time gap, which is about 60 years of planning. Now, some of you may say, but I could buy an annuity from an insurance company that gives me this kind of cash flow profile. But what we find is two things. One is that there is an annuity puzzle, which is people don't like to buy annuities for whatever reason. But more often than not, annuities are not a very flexible instrument to buy during your working life because you're not sure whether when you get to retirement, whether you actually want an annuity or not. And so as a result, annuities haven't been the solution to this problem because people now are starting to think about decumulation, and annuities typically can be very complex for the average individual to understand. Now, you may have seen these charts yesterday, but I'm going to repeat them because Professor Merton, I know, touched upon this topic. And the key point that we found as we look globally is that the industry tends to use the wrong safe asset. What do we mean by that? If we look at short duration instruments like a US 3-month T-bill or a short duration bond in any of your countries, the good news about this bond is that it protects the wealth of the investor and therefore typically has very low return volatility. So it looks like a relatively safe asset because it protects your wealth. But if we look at it in terms of what kind of an annuity could the same instrument buy, you can see on the right-hand side that the short-term financial instrument, a bond issued by, let's say, the government, gives very uncertain retirement income. And actually, one of the challenges globally has been because of the substantial decline in interest rates, the same amount of wealth now buys much less retirement income than it would have bought, let's say, 10 years ago. And so as a result, current products and portfolios that people have been invested in, whether it was a stock bond portfolio or a life cycle fund, which we thought was safe from a wealth perspective, could end up being very risky from a retirement income perspective. And that's why it's very important to make sure that we get the right lens to understand what the goal is, because the optimal instrument depends on the goal itself. If you pick wealth as your goal, then short-term bonds may be the appropriate instrument. But if you pick retirement income or standard of living as your goal, then those short-term instruments are very risky. Now, some of you may look at this and say, well, Arun, rather than just buying a short-term treasury instrument or a financial bond, what happens if I buy, let's say, a 30-year treasury inflation-linked bond? And so what we've modeled on the right-hand side are the cash flows from a bond. And again, I think Professor Merton may have shown you this slide. The green line tells you the price you might have paid to buy the bond. And then for the next, let's say 30 years, you receive these red coupons. And at maturity, you get your principal back again, adjusted for inflation. The problem with this bond is it's starting to pay you coupons before you need it in retirement, which is marked by the R. And then it's also got cash flows that are very different from the bond, from the goal that you have of a steady cash flow of nothing but income. And so what happens is you need to conduct many transactions to convert these cash flows into your desired retirement income stream. And this is going to be costly, it's going to be expensive, and it's going to be risky. And the bigger problem, as I mentioned earlier, is that this bond only protects you against inflation. But in retirement, what we're finding is people have had to take a reduction in their standard of living. And as a result, are not leading the same quality of life after retirement as they had before retirement. And so traditional bonds, instruments that have been used and treated as safe in most DC pensions, are actually quite risky from the retirement income perspective. So is all hope lost? No, we think that there's a good solution. And we call it Selfies, and I'll explain the name in 1 second, but let me describe the bond to you first so that you understand what we're trying to do with this instrument. The idea would be that the government issues a new bond, and the key features of this bond would be that essentially it would start paying people at the age at which they turn 65. So each cohort would have a bond that pays when they hit 65. So for example, if you're 60 today, you would buy the bond that starts in 2025. And that bond would pay you only coupons for, let's say, 20 years, which is the average life expectancy of the country. And we show that in the chart here by showing you this little stream of dark green lines, where rather than paying you the traditional coupons that you got from a bond, which would be expressed in percentage terms, in Selfies, the bond would pay you, let's say, $5 real per year, 5 pesos real per year, or maybe even 10 reais per month. It could be any simple design that applies to your respective country. So the black line here in this chart shows that $5 real per year in coupons only for the 20 years. The green line is the nominal payment that you'll actually receive, and I'll talk about the nominal adjustment in a second. So the bond from age 25 to 65 pays you nothing. And then when you get to 65, it pays you a steady stream of 5 per year in real terms. Now, why did we pick this design? Because if you remember the goal that we expressed earlier, that people want 50,000 annually in real terms, and you have a bond that now pays $5 real per year, then we can simply express the goal of the individual as buying 10,000 bonds before they reach retirement. How did I get 10,000? My goal was 50,000 a year. If each bond pays 5 per year, then I divide 50 by 5, and essentially that's how I get to the 10,000. This requires just the most basic mathematical calculations that any individual can do. And what's nice about this is that it's very easy to track your progress in terms of where you are relative to your goal. If today you've bought 6,000 bonds, then you've achieved 60% of your goal. And that tells you that either you need to save some more to buy the balance of the bonds, or you need to take more risk to be able to achieve your target, or you have to lower your quality of retirement lifestyle if you don't save anymore. Now look at one interesting feature of the Selfies bond. What happens if somebody dies before the 20 years of the bond maturity? The nice thing is now their children or their wife or their husband can take the bond and either continue to collect the income or sell the bond. Whereas typically in an annuity, the annuity expires worthless the day after the person dies. So finally, one of the other interesting features with Selfies is if you decide to change your retirement date, in this case from let's say 2060 to 2055, all you need to do is just buy the bond that starts paying from 2055. And if you change your goal from 50,000 to 40,000, that's fairly simple. Now your goal is 8,000 bonds and you don't have to do a lot more. So it's very easy to make calculations and conduct your computations using Selfies as opposed to using treasury bills or tips. So the key point we were trying to do is we wanted to establish Selfies as a better safe retirement asset so that now we've got one of the primary building blocks to designing better retirement solutions for people around the world. So let's take a look at the design features in a little bit more detail so you'll understand why we call them Selfies. Because we designed them to require no additional training, what we did is we made sure that the bond cash flows exactly match the retirement goal, which is no cash flows until you hit retirement, and then a steady cash flow only with no bullet repayment. The second most important feature was the payment was based on real amounts, not on a percentage coupon as you normally find with the bonds, and that's the dark green line. And then the question is, okay, what is the nominal adjustment that we would provide so that people can maintain their standard of living? And this is based on a paper that Professor Merton wrote many years ago, is we would link the nominal payments to per capita consumption of the country. Why is this important? It's very important because if the bond is linked to per capita consumption, then it hedges the real standard of living risk of retirees, because if the economy is growing and people are consuming more on a per capita basis, then the payments on Selfies go up and the retirees are also able to consume more in their retirement from the same real dollars. So they get protection from both inflation as well as protection from standard of living changes. The next key point is it's forward starting, and that's where we get the name Selfies from. Selfies stands for Standard of Living Indexed, Forward Starting, Income Only Securities. Again, Standard of Living Indexed, Forward Starting, Income Only Securities. And so the whole point here was that if we design the bond to match the goal of the people that are trying to plan for retirement, it makes for relatively easy calculations. Why is that true? Because what we've done within this bond is we've embedded inflation, compounding, and decumulation all into one instrument. And I know in many countries in Latin America especially, decumulation is becoming an interesting challenge as it is in countries like Australia, where initially a lot of focus was spent on the accumulation part. But what's nice about Selfies is Selfies have a built-in decumulation already structured into them. So it requires no additional effort on the part of individuals. All they need to do is specify their retirement date and target income. And if they acquire the right amount of Selfies, then the rest of the decisions are relatively simple. What's nice is we've written a number of proposals for countries to consider around the world, very much with the same design features. And so we can show that the same simple design applies in many countries without a lot of customization. Now, let me quickly summarize in the last few minutes that I have of my presentation why Selfies are good for individuals, why they're good for the governments, and why they're good for the financial services industry. Selfies are good for individuals because we designed them to work with what people already know. So they don't need additional training, makes it much easier to start to get people much more engaged in their retirement system. Like I said earlier, because the bond embeds compounding inflation and the accumulation, it takes care of the competence and the financial literacy challenges that we know exist globally. Probably the biggest selling point in many countries is going to be the fact that it works for uncovered workers, or what we today call gig workers, right? Those people who work on their own on small projects. Because what's nice is if you buy Selfies, in effect, you're creating an individual defined benefit plan. You don't need to be part of a pension plan to earn the kind of retirement payment stream that Selfies provide. And so, in a way, with Selfies, you've created a way for uncovered workers who buy these instruments to give themselves access to a type of retirement system. And finally, it's extremely easy to track your progress towards your retirement goal because it's extremely simple math and easy calculations. So I think on the basis of these 4 points that we laid out here, I think we can argue that we made the criteria of can this be used straight out of the box, and we've achieved that goal that we set out for us. Now, some people might want to know, why is it that the government needs to issue this bond, and couldn't somebody else issue it? The reason we've suggested that the government should issue this bond is that first and foremost, if everybody retires poor, then the governments are going to have to bail out individuals. And I think last year we saw in a number of countries, governments having to raise the level of minimum pension payments because people were going to be retiring poor. So if retirees are ending up to their close to retirement without sufficient retirement income, the governments are always going to have to bail them out. And so it's important for the government to create a solution which minimizes the likelihood that people retire below their threshold retirement income. The second interesting thing is that the cash flows from this bond are very synergistic with what a lot of countries need for infrastructure. Namely, you get cash flows today, and then they have to be repaid, let's say 20, 30 years from now. When you think about infrastructure projects, you need to invest in infrastructure today, and the payment typically comes 20, 30 years from now. And many countries are talking about social development goals. Many countries are having to deal with having to fund COVID-related challenges. Selfies could be the instrument that could actually help structure the funding for those long-term needs. The third interesting comment is that if a country has a value-added tax regime, because the indexation is to per capita consumption, the government is hedged. Namely, that if they get higher receipts from the value-added tax, then that's going to be offset by the fact that there's a higher standard of living, and therefore the Selfies payment could be higher as well. And so the government has a much better match between its income and its payments on Selfies. For countries in the developing world, this helps boost the national demand for debt so that they don't have to be dependent on external sources of funding, which create instability when markets are wobbling. And also, in some cases, it can help them provide near-term budget relief. So for governments, there are many reasons for which creating Selfies and issuing them could be a really good idea, especially as governments have closed social security systems and moved people into defined contribution systems as well. Now, one of the interesting questions that might come up in the question and answer session, and I'll try to address it quickly here, and we can also talk about it more in the Q&A, is that if the bond only pays for 20 years, as we've said here, then what happens if somebody lives beyond 20 years, right? So if the bond only pays for 20 years, and that's the average life expectancy, what happens if I live to 30 years? So interestingly enough, what Selfies can do for you, and this is something that Professor Merton and I have written about, is let's think about the goal of the individual. They would like to have sustainable retirement income, and if they buy Selfies, then they still have longevity risk. Now, a lot of insurance companies in your countries have a slightly different incentive, which is they'd like to offer annuities to your participants, but they'd also like to make a profit, and they would like to manage the risk. And the way they do that is if they diversify the risk by signing a large number of people. Now, what happens to an insurance company when they sign a large number of people to their annuity products? The expectation is that their longevity experience is going to be somewhere in the region of the average life expectancy of the country if they're well diversified. And so what we argued is that if you design selfies well, maybe pay a few more years than the average life expectancy, then the insurance company should be willing to exchange one selfie for a life annuity that pays you exactly the same coupon all the way to death. Because when you show up to the insurance company, they don't know if you're somebody who's going to die before the 20 years or whether you're somebody who's going to die after the 20 years. They can make a probabilistic guess. But if they get an enough diversified pool and the average experience is the average life expectancy, then selfies become an attractive hedging instrument for them in managing their own risk book. In addition to this, selfies can help you create better target income products, which Professor Mantia talked about a little bit yesterday. And we've written a paper in the Financial Analyst Journal where you can help people achieve their retirement goals. And so selfies can be good for the financial services industry as well. So to summarize, selfies have the potential to be a win-win-win for the three main stakeholders in any pension reform. It clearly meets the needs of individuals because it's a retirement income product that meets their actual goals and is very easy to use. It could help the financial services industry by helping them either provide better annuities, which are better hedged. It could help them provide target income products and other products that people actually want. And thereby, they can offer a much wider product offering to the citizens of the country. And finally, it could be beneficial to the government as well, because it could lower financial pressures, give a better likelihood that people don't retire with a very different expectation of what their retirement income is than they had before. It could offer a better cash flow match in terms of how they are linked to value-added taxes and could potentially fund some of these long-term needs from infrastructure, social development goals, or even considering what we're dealing with COVID, it could fund COVID. So to briefly summarize where I started at the beginning, the whole idea behind selfies was that we wanted to create a bond that replicates the payment pattern of a pension fund. Namely, no cash flows until you hit retirement, and then a steady stream of cash flows that's linked to the standard of living of the country. The whole idea was that this simple design could work in any country with a bond market. By providing inflation and standard of living protection, what we were able to do is make sure that we protect people against one of the biggest risks in retirement, namely standard of living risk. It requires no additional training on the part of individuals, and it's based on what people already know, which is their retirement date and their target income level. And as you can see, if somebody just buys selfies, one transaction is all they need to do for their entire retirement, as opposed to if they buy treasury securities or they buy inflation protected securities, there's a lot more financial engineering that needs to take place, thereby raising the cost. And so in a way, what Selfies tries to do is create a simple individual defined benefit. Uh, After this presentation, I just thought it'll be interesting to find out from the audience, after you've heard what selfies are all about. And if we can put up this next poll, please, whether or not if selfies are available, would you actually consider buying them? Could we put up the next poll, please? I think we're down to the last few respondents. Yes. Are you able to see the results? So that's quite interesting. 86% of the attendees would actually buy them. With that, I'll stop my initial comments and I'll take questions and look forward to a good discussion on selfies.
Thank you very much, Aaron. That was quite a success in terms of the poll. I think there's lots of interest from our audience, and we got many questions. So thank you very much for that very concise, and I would also say very clear presentation. So as I said, we had many questions, and we have like 20 minutes or so to talk about them. Well, let me start with this question that says, are selfies complementing or competing with annuities?
That's an excellent question. So the way Professor Merton and I see this is we see these as being complementary because annuities clearly have a benefit to providing your protection against longevity risk. And essentially, what we've done is we've said that we don't want to try to create another annuity instrument, but rather we want to create a better safe asset for retirement. And as you saw in that example on longevity risk, essentially what we found was that for people who think that their life expectancy is less than the economy average, they may just hold selfies and that gives them the protection because if they die before the average, then their family gets the bond. But at the same time, by having selfies available, then the insurance industry can actually use this to hedge their own portfolio of risks. So for some people, holding selfies might be the only decision they make when they get to retirement and they decide that's all they want. But for people who think that they're going to have life expectancy that extends beyond the average, that's where they can use the annuities. And having selfies allows people, the insurance companies, to better hedge their own risk profile. And that's why I think they're much more complementary and not competing at all.
Thank you, Arun. Is it possible for you to activate your video? Do you have enough?
No, I'm sorry, I don't have a video. Sorry.
Internet power?
No, I don't think I am okay.
Okay, no problem then. Just double checking. Well, thank you for that. Oh, yeah.
Sorry.
Great, no problem. Thank you very much. Okay, there are a number of questions. I will try to group them. I guess the audience, some people in the audience are intrigued about what could be the effect of introducing these in current contexts, particularly here in Latin America, where, as you know, we do have AFPs managing the savings of affiliates. So maybe if I can summarize it, I would say in just one question, I would say, are selfies only for individuals or also for institutional investors? Because going more into the detail, some of the questions, just for the audience to relate to this, some of the questions were about whether there is still a role. Let's assume that the government issues selfies. Is there still a role, for instance, for AFPs or for pension funds or institutional investors, or are we killing them?
Very good question. Actually, the whole anticipation was that the primary people to buy selfies would actually be the institutional investors. Because at the end of the day, if you're running a pension system, if you're an AFP or whatever, essentially you're trying to provide your participant with a good retirement. So they would be the intermediary for people who are already participating through existing pension funds or insurance companies. And this instrument allows the institutional investor to not only create a better pension, but also better products that they can try to innovate around. So the primary buyer of this instrument we see as being the institutional investor. Now, in countries like Brazil and some other countries as well, what we know is that they have facilities where they actually sell bonds directly to individuals based on the price that has been set by the institutional investors. So they call it Treasury Direct facilities. And so it's critical that the institutional investors purchase these bonds for their own products, for their own participants that they're catering to. Because once they establish a market price, this bond is not going to be subsidized, right? This is going to be a purely market instrument. There's no subsidies in this. That price can then be used to sell it to the few people who buy the bonds from the Treasury direct facilities. And so you could have some retail purchases, but our expectation is that the primary purchasers of this selfies would be the institutional market itself.
Thank you very much, Aaron. There are other questions regarding, I would say, more on the concept. One person from the audience asked if you would be kind enough to revisit. He would like to understand why do you say that current life cycle products are not efficient or are too risky actually if they are not using selfies but the normal or existing bonds? And then there are many other questions on concepts, but let's start with that and then I follow up.
That's a terrific question. So let's take a look at a typical life cycle product. The typical life cycle product moves you from stocks into bonds as you grow 1 year older, let's say, for example, right? So you could start with 60% or 70% stocks when you're 25 years old. And let's say it sells 1% of the stocks as you grow older. And so when you hit retirement, maybe you have 30% stocks in your portfolio and you have 70% bonds. The two primary challenges, and if you want, I can send a paper after the session to whoever is interested as well, is one, as we said, the bond portfolio into which they're rotating is risky from a retirement income perspective. So the bond portfolio may protect them for wealth preservation, but it doesn't preserve them for retirement income because we've seen that bond products in the traditional structure give you very volatile retirement income. The second challenge is that the only difference in the rule is that just because you became 1 year older, you should go more into bonds. And that has no connection to the goal of the investor. So if the goal of the investor was, I want 50,000 pesos at retirement, then just because they're 1 year older doesn't mean that you have to rotate in that fashion very naively. So it's goal independent, right? And so what we have done is we've actually shown in a paper that we published in the Financial Analyst Journal how you can come up with a better variation of the life cycle idea. It's what we call goal and lifetime income based dynamic strategy, or glides. We call it glides, which is linked to the goal and uses selfies so that you can basically make sure that the level of retirement income that you're buying is somewhat protected. And in fact, some of the work, Manuel, you and I and Professor Manti are doing tries to create a product that guarantees whatever retirement income you had in the previous period. So I call life cycle products part of the evolution of product design. But because it's based on these two high level concepts, which is the bond portfolio is risky from a retirement income perspective, and that the rule is independent of your goal and it's only based on your age, it's insufficient to guarantee an adequate retirement.
Thank you, Aaron. And I will now try to merge 3 or 4 questions, very interesting questions that we have. Uh, I would say the questions are about how would selfies fare under current rates, which are either very low or even negative in different parts of the world. And related to that, whether you think that a better solution is to have selfies and equities, so 2 types of portfolios to achieve a good retirement income.
Great. So let me start with the second one first, because that's an easier question. Um, in the paper that we just published in the Financial Analyst Journal, we show a simple rule between how to allocate between selfies and, let's say, equities. So we believe that any good portfolio should be diversified. It shouldn't all be selfies unless somebody is extremely risky and risk averse and doesn't want to take any equity risk. But in most cases, you would expect the typical portfolio would have a mix of selfies and stocks. And depending on where they are relative to their goal, that's where you would actually see the evolution of selfies, right? Is from a portfolio perspective, all assets would be needed, including selfies. The second question, the first question, which is a harder question, is what would the price of selfies be given that we're in a very low interest rate environment? and potentially in some countries, even negative interest rates. Remember, selfies are a pure market-based instrument, right? There's no element of creating something different from what the market is pricing. So if interest rates are negative in a country, just like current bonds are priced using those interest rates, selfies will be priced using that same yield curve. Just because interest rates are low, the price of selfies will be high just by natural evolution of what the interest rates are. One of the reasons I would like to have selfies available is as central banks have been lowering interest rates to stimulate the economy, they've actually made the price of retirement very high. So one of the unintended consequences of lowering interest rates has been that retirement has become more expensive. And so that's why Professor Merton and I call selfies a currency for retirement, because it tells you how expensive retirement is becoming. And so if central banks continue to lower interest rates, they're going to be making retirement more expensive because, like you noted, if you have negative interest rates, the price of selfies are going to rise as well. So selfies are going to react just purely to market forces, and it's not going to have any dimension of subsidization because interest rates are negative or positive. We don't advocate for that.
Thank you very much. I would like to thank our audience. There are many, many questions, very interesting questions, and apologize in advance if we don't have time to cover all of them. But thank you very much for your interest. Let me see. Um, well, there is a very interesting one here saying, "Can selfies be green?"
Yeah, in fact, one of our arguments was that selfies, if they're used for social development goals, could very easily cover green products. In fact, the other day I was talking to a Northern European country, and their question was, and they've got a very established defined contribution system, whether or not a selfies could be green. And that makes it very clear because, that the government can use it for whatever purposes it deems appropriate. Uh, but you have to make sure that the return that the government earns, which I think is related to one of the questions somebody asked as well, is subsequently sufficient to be able to pay off these bonds in the future, right? So as long as the investment that you're making in the country, whether it's a green bond or a bond for a bridge or a bond for a railway line, as long as the return on investment is sufficient, the country is no worse off. Um, if it's wasted money and it's put into bad projects, yes, sure, then the country is made worse off. But the expectation is that the country is already borrowing today. If they're going to issue a green bond, why not make it a green selfies? Because it gives them a longer term maturity over which this can be efficient. And that way, you could actually make sure that both aspects are covered, which is retirement as well as infrastructure funding.
Great, thank you very much. Another one says, what would be a standard of living risk measure for Latin American countries? Should it include the medical expenses, for instance?
That's a really, really good question. In fact, yesterday I made a presentation to the Society of Actuaries where that was also asked. The way we've designed selfies is we've tried to keep it simple so that the only standard of living risk measure that we kept was per capita consumption, whereas in retirement, one of the bigger risks is medical costs. So what we would recommend is that for covering the medical costs of people in retirement, ideally they should have a separate savings pool that would be linked to the cost of medical inflation and retirement. Because otherwise, if you make the coupon too specific to individual risk characteristics, then it makes it hard for the bond to be mass marketed to the country. So that's why we chose an economy-wide standard of living risk measure and not something very specific to health and retirement, which is a very important risk to manage as well.
Thank you. And again, thank you for the very good questions. We have a number of questions regarding the government's role. I will merge them so we cover all of them. But basically, it's really about people in the audience are a bit worried about whether if you buy and provide resources to the government that are only paid back many years later, that money will be there. So it's more about the governance of the scheme. So that's one type of question. Then there is also another question regarding governments, which is about government debt. So some people in the audience are asking whether selfies would imply governments to increase their debt levels, which are already probably at historic levels, or not.
So that's an interesting question, because one idea that we had was that selfies could potentially replace existing debt. So you don't need to issue new debt to create selfies. But remember, in a lot of these pension plans, current bonds are already sitting in these pension plan portfolios. And so if we believe retirement income is the right measure to measure retirement security, then it would be more appropriate to put selfies instead of the traditional bonds into those portfolios. So at a simple level, we could argue that some amount of selfies could potentially just replace existing debt. Now, to the extent that countries are issuing new debt for COVID and for other stimulus purposes, then selfies could be the alternative to the traditional debt instrument because it'll solve the retirement issue. The third part that's been raised, which is what happens if the government then just goes and spends the money badly. You already have that risk today when the government issues debt. So I don't know if selfies makes them much worse than or better than what they are. Uh, I like to have the expectation that the governments are doing their best to look after the people. The benefit with selfies is that it addresses the retirement problem, which is not being addressed today, and that risk is being carried by individuals. And the government is going to have to pay anyhow, because if people start to retire with low retirement income, then they protest and they get upset. And then the government ends up having to write them a check anyhow. So the fact that governments could behave badly with the money, that's a risk that already exists. I don't think selfies makes it particularly different in my mind. I could be wrong about that, but that's my expectation.
Thank you, Arun. We are running out of time, but probably we have time for one more question, which is about whether, I mean, you've been discussing this with different governments around the world. So whether you see governments interested in doing this, whether there are already some efforts available, so some case studies available, or whether you see this is coming.
I think this is coming because we've had very interesting discussions with countries, both developed as well as developing. It is a global problem. So pensions problem and the pension challenge is not going away. And I think the more innovative countries that realize that if they don't do something, then the problem will get more expensive and become more dramatic are the ones that are going to probably create a solution sooner rather than later. It's interesting, Uruguay has issued a variation of this already because they had to fix their pension system where they issued a very unique bond, which has selfie-like characteristics, but was designed just for the state pension. So I think there's already been some innovation. There's potentially much more coming from countries, both on this call as well as other countries as well. So I think it's only a matter of time where some variation of selfies will become a reality, because otherwise we can't address this pension challenge any other way.
Well, thank you very much, Arun. I think this was a very enriching session. We do have probably 1 minute. If I may ask you for a 30 seconds final message, and then I will also provide some words for the audience.
Okay, no, thank you. The final message is that we hope that what we've conveyed today is a simple idea which could be applied to any country, which has the benefit of potentially helping uncovered workers, and which helps countries address two major problems: retirement security and infrastructure. And if there's any way in which we can help any country try to implement this, Professor Merton and I are always willing to help. Thank you.
Thank you very much. I would like now to share a screen with you, just to, while the screen is there, I would like to thank everyone for joining this session. I enjoyed it a lot. I am sure you also did, and that shows up in the high number of questions. Probably this is the session with the highest and level of participation. So thank you very much. I would like to remind you that this session is being recorded and that the recording will be available in a few days in the website. And finally, I would like to kindly ask you to join us tomorrow for the last day of the Global Pensions program. We will have some wonderful keynote conferences and also a session with representatives from different international organizations, as well as a final message from the Ministry of Social Security of Spain, talking about that, the reform in that country. So thank you very much all. Have a good day. Bye-bye now.
Thank you very much.
Thank you, Arun. Bye-bye.